How's it going, everybody? Happy Wednesday. Welcome to the Hot Corner Live Strategy Session. I'm your host, Steve Straza, Director of Research at All Star Charts. Got a lot to talk about today. I'm excited. Nothing we discuss here constitutes any solicitation to buy or sell securities. This is solely for informational purposes, not to be construed as investment advice. For more on our disclaimer, you can go to our website, allstarcharts.com/terms. So, why am I so excited? We're going to have some volatility today. It's decision time, right? What am I talking about? Why do I say that? We have an FOMC meeting. So the March meeting is today. We'll get a decision in 2 hours, just under 2 hours. And this Fed meeting is a bit different from all the FOMC meetings in recent history because I don't think the market really knows what the Fed is going to do for the first time in a long time. So I'm showing our target rate probabilities chart here, table rather. This is based on the Fed Fund futures at CME Group. It's incredible information, awesome data. I'm so glad we have it. 86% chance of a 25 basis point hike. This is where we were as of yesterday. Maybe even we ran this as of this morning. It says as of March 22nd. So this is as of this morning. 86% chance we get 25 basis points. I would not rule out zero. My personal take on it is zero could be more harmful than 25. I think the Fed is done and should be done and doesn't want to do 25, let alone 50. Definitely not getting 50. You know, banks are breaking for the past 2 weeks now. It's just not an environment where the Fed should step in and continue to raise rates, because really the main reason why these banks are breaking is due to the rapid increase in interest rates over the past year and a half, right? So they would just be adding fuel to the fire that's already burning. They don't want to do that. They don't want that. They don't even want that on their plate at all. But I think if they come out and do zero, that spooks the market even more because that gets investors thinking, what do they know that we don't know, right? The Fed has been behind closed doors in meetings with all these regional banks and big money center banks trying to figure out how to bail out, who to bail out, what that bailout looks like, et cetera, et cetera. And the Fed, Treasury, FDIC, and all these big banks and regional banks. So if they were to come out and do nothing, maybe that has, an even worse impact than if they did 25. So I think they do 25, they save face. I think we move on. Everything's fine. But, last week I shared this chart. And while I still think, new bull market, this is still the bottoming process playing out in large part. It's messy. It's supposed to be messy when we're transitioning from a downtrend to a new uptrend. But this chart really, it got me last week. We talked about it on here. The bond market volatility that we saw over the past 2 weeks is not something that I'm going to take lightly, right? I need to see it be confirmed by price, right? By the price of risk assets, stocks in particular. But I am on as high of alert as I've been, in years about the price action we saw last week. So the 3-day rate of change on a nominal basis and the U.S. 2-year yield hasn't been this low, almost 100 basis points since 1987, since Black Monday, right? We haven't seen the short end of the curve come crashing down such a rapid pace as we did last week. The break-even inflation rate, this is the market's expectations for inflation. We haven't seen a move like this since COVID, right? Market repricing what it thinks about inflation. I think the Fed broke inflation. Credit spreads, the most important, the least severe move. That's really good, in my opinion. We don't want this chart, particularly the rate of change panel, to start looking like these other ones, right? And it doesn't yet. But so this is the inverse of credit spreads. you see new lows here, but they're hitting their highest level since October. Okay, so this is the best evidence of bond market stress that we have. We don't want to see this chart blow out lower. Watching it very closely. Twos, tens. So the spread hasn't seen this kind of move since the early 1980s. Treasury spread. Here's your chart point. Here's your spooky chart of the day, right? The last 3 times that the twos, tens spread has reversed and started moving higher, which tends to happen when the Fed is drastically cutting rates. Pretty much every time when the Fed is just slashing rates, the twos, tens spread, really starts chugging higher. Dot-com bubble peak, we crashed. Great financial crisis, we crashed. You could even throw COVID into the mix, right? So does this play out again? We haven't seen the kind of downside we saw these last 3 times yet, I don't think. So that's one to spook you. And financials, right? The regional banking crisis really rages on. First Republic Bank, I don't know what it's doing today. It rallied a lot yesterday. They're trying to figure out, but look, the damage is done. This was a $100 stock just earlier this year, earlier this month. $15 today, right? So the banking stuff is going to continue. Last week we talked about Credit Suisse. We talked about how it looked very much like Credit Suisse would be the next domino to fall. That happened. The market cap, I was looking at it last week. They had a market cap like $10 billion last week. I said, this is way too high. It's just way too high. Repriced about $3 billion today. So Credit Suisse is done and over with. UBS will be taking them over, which is an interesting move. But, you've seen the Swiss banking sector just go through some huge consolidations over the years as Swiss banking has become less of a global presence. So UBS now taking over another big bank, Credit Suisse this time. So if we're worried about all this bond market volatility, right, and if we see a big move in 2 hours, a little under 2 hours from the Fed, I'm sorry, it's 1 hour now. If we see a big move from the Fed today, or the Fed spark a big move in markets, we have our levels, right? So we can draw a line in the sand to say, okay, things could be getting ugly here. I want to be on the sidelines, right? Or I want to manage risk in a tighter way, right? Or I want less exposure. US dollar, if this chart digs in here and moves higher, that's probably not a good thing. We want to see this break down and move lower. That would be a tailwind for risk assets. Rates, I would say the same thing. We don't want to see rates continue to rip higher here. We also don't want to see them plunge, right? We want to see orderly price action in the bond market. But I would say lower for longer or lower in the future would be better for most risk assets. And here's your line in the sand for stocks, right? It's the Russell 2000. It's really simple. We've seen buyers step in and defend this level so many times over the past year, right? This is just last year, 1 time, 2 times, 3 times, 4 times, right? We're here again. So call it 170. You got your 2018 highs and your pre-COVID highs. The Russell 2000 does a really good job at illustrating how the average stock or the median stock is performing, right? It looks a lot like the value line in many cases. So this is one of my favorite indexes for that reason. That removes a lot of the cap-weighted impact and the mega cap and large cap factor that we have in the major indexes. So 170 in the Russell, if we're below there, that would warrant more caution from investors, right? We would certainly be approaching markets with a heightened degree of caution in that scenario. Financials, this is the most important chart in the market right now, that 30-50 level. Financial crisis highs, 2018 highs, 2020 highs. If we're below there, that means things are getting really ugly for these regional banks. And I mean, look, for financials to fall this much, this fast, this is not just contained to regional banks right now. This is a broad financial sector issue, right? Where a lot of these companies are struggling with balance sheet management, right? A lot of these companies take on large amounts of deposits and then have to do something with those deposits. And if they did the wrong thing over the past year or two, they're in a lot of trouble right now. So that goes for brokers, capital markets firms, even insurance companies, right? It's not just the banks. So XLF below 3050 tells us things are getting pretty ugly. We have these prior cycle highs in a lot of areas that we can use right now, because I think it is a time to pay close attention to the heightened volatility and protect our portfolios, right? So if you're in a lot of energy, these are the levels. 2018 highs in crude oil, not good. If we're below there, I would imagine this breakdown in XLE is a valid one, and we remain below 78, those 2018 highs in large cap energy. When you look at the growthier or more speculative side with interest rates coming down, cryptocurrencies look pretty good. So you got the prior cycle highs from 2018, play Bitcoin and Ethereum off of that. When we look at Bitcoin and big tech along with bonds, these are all long duration assets. If you're asking yourself, well, what do bonds have in common with Bitcoin or big tech? Why do those charts even look remotely similar? Interest rates. That's why. They're all highly sensitive to interest rates. So as rates have really come down, came crashing down, in the case of the 2-year, right? We have that chart right here. Biggest move since 1987. As rates have ripped lower, these long duration assets have had a great time, right? Completing these big bases. Bitcoin already went. Tech is close to going, and TLT is threatening the same. So do big tech and bonds follow Bitcoin? Maybe. How does tech look today? Looked good this morning. Yeah, new highs, right? So XLK on pace for its highest level since late August. So what is this all doing from a growth value perspective? We want to be in value when rates are rising, typically. We want to be in growth when rates are falling. Growth stocks are starting to suggest that maybe rates peaked, and that was it. We got our second highest reading in history in the growth versus value ratio in favor of growth just last week as rates come crashing down. At the same time, financials on a relative basis are having their worst week since the financial crisis. So you pretty much have tech in the numerator, the growth piece of that ratio, and then you have financials in the denominator, right? The value piece of that ratio. So with financials breaking down, looking terrible on a relative basis, technology ripping on a relative basis, this growth versus value ratio, I think, reclaims these dot-com bubble highs. And I think we enter an environment again where growth stocks are back in favor. All right, so we've talked a lot the past few weeks about the banks and the insider buying in banks. Here's the problem. A lot of these banks, and look at this long list here, Cullen Frost, Big Energy Bank, PacWest, Lakeland Financial, Metropolitan Bank Holdings. The CEO of this company came right out, bought $500,000 worth of stock. The same with Customers Bancorp. These two, for me, some of the best insider buys we've seen since the regional banking crisis began. Glacier Bancorp, Schwab. I love all the insider buying from Schwab. Look at this, 7.5 million from a handful of different insiders. You got the CEO, CFO, president, everybody important on there, plus a handful of directors. Love to see that. Good for Charles Schwab. That is one of the financial stocks that I do think makes sense here, even from, or especially from a long-term perspective. I think Schwab is a great company. And anytime you can get a great company, in some sort of like disaster scenario where the price is really selling off like this, I think is often a gift. So Schwab is one I'm interested in. The problem for me is a lot of these charts, we're still below key levels, whether it's Schwab, Bank of America, JP Morgan. Anyways, I like to see this kind of insider buying. I hope it continues for the big banks. Problem is these charts just had holes blown in them. So if we're going to step in, we got to zoom way out on these charts, right? And look for logical levels, polarity levels, which would typically be prior highs or lows from years and years ago, right? So hard to step in and buy something that looks like this over the short term. But using Schwab as an example, right? If we zoom out far enough on these charts, we can pick some really logical risk levels, right? And craft trades off of those levels. So Schwab saw this automatic reaction lower, blew right through those dot-com bubble highs, and then recovered, and now back above the 2018 highs and pivot lows. I think 60, or is it above there? I think we're right there right now. Yeah, we're at 57.27, so we're not. I think Schwab, you only want to own it above 60, right? Make it prove itself back above those 2018 highs. If you can buy weakness back towards 5150, fine. I think you could trade that, but I'd rather see this stock start moving higher rather than continue to move lower, right? I would have a lot more confidence buying this on strength above 60. And here's just some of the other regional banks on our list. FBK, FB Financial Corp, top, completed. You don't want to touch it unless we're back above 36. East West Bank Corp, clean top, completed to the downside on that Silicon Valley Bank volatility. Blew right through the pre-COVID highs, right? Now we're just in the middle of no man's land. Wintrust Financial, a little bit cleaner. If you want to step in here, fine. Against 73.50, I guess you could do it. But look, this looks like a lot like a top like the others here, right? Do we get similar downside follow through? I don't know. To me, when I look at a lot of these financials right now, they had a strong leg lower, and then they've coiled the past week or so, right? Look at Schwab, look at Bank of America, look at any of the ones on our insider activity table, MCB, CUBI. They just blasted lower and then started coiling in these continuation patterns. Well, continuation patterns tend to resolve in the direction of the underlying trend, which is now lower for all these banks, right? So until I see those patterns fail, I'm skeptical and not a huge fan of stepping in, especially with a short-term objective in any of these names. Like I said, something like Schwab, if you're telling me I want to own this stock for the next 5-10 years, yeah, great. This is a good level to do that, But if you're telling me, hey, I'm looking to trade this East West Bank Corp, I would say, nope, that's a, big top that just completed lower, bearish continuation pattern. From what we've been taught, the textbooks, technical analysis tells me this resolves lower. So until I see these patterns fail, prove me wrong and resolve higher, not a big fan of stepping in over the short term in financials. New setups. I figured we'd keep it short today because we did a lot of macro because I think that's what's important right now. I could bring you a ton of setups, but if the Fed spooks everybody in 40 minutes and markets tank and we had all this bond market volatility, I would feel bad not having made that the focus today, right? Wingstop, gonna buy something. Look at these guys. They're selling chicken. Fast food, chicken. I've never had it. Wellington Management, they seem to be big fans. I'm a big fan of Wellington Management. They're big fans of technical analysis. Over 10% ownership in Wingstop. Filing was August of last year. Look at this base. What a pretty name. Yeah, beautiful base breakout coming here. We like Wingstop above 187 with a target of 261. We'll have a post about this on the website later. General Electric. I think they have that big spinoff coming. They're breaking the whole company up, which is usually a great thing. Just look at this base. Incredible. Stock has been so bad for so long. I remember this. It wasn't 200 then, just so you know. There was some sort of reverse split in here. It was like a $20 stock back then. But I remember when things fell apart for GE. Spinoffs like they are talking about doing, and the plans are already in place, it's happening, tend to generate a tremendous amount of shareholder value. So maybe that's being priced in now. If we're above 90, this is as good as a bearish to bullish reversal pattern comes, called a rounding bottom. It's go time. You call it head and shoulders too, right? Go time above 90, target of 135. GE looks as good as anything. Industrials are doing well. I think it makes a lot of sense. Standex International Corp, SXI. This is a tech stock, believe it or not. Doesn't look like a tech stock, look kind of like an industrial to me. So if we're above 114.50, SXI looks good. Another really nice base here, just breaking out, called a cup and handle above 114.50, target of 162. These are all new setups. Cirrus Logic, this is a semiconductor. If I know my stocks. Yep. So Cirrus looks as good as any name in the semiconductor space right now. We're above 103 and change. Means we're taking out those 2021 highs. This one's a secular leader. If we were to zoom out on this chart, you would just see this thing's been moving higher for over a decade now in a steady constructive way. above 103, target of 129. That's serious logic. We want exposure to the semiconductor space right now as much as any industry group. Semiconductors look great here. NVIDIA, example number one, right? So NVIDIA, we talked about last week. This thing keeps working. So 248.50 is that level. I think we're going back to those former highs, 335. Meta, here's another trade that's been working for us. See how Meta's doing today. These are the stocks that you want to be in. You know, it's big tech again. Bonds, Bitcoin, and big tech. I really think that could be the 2023 playbook. So Meta above 200, talked about it last week, target of almost 300. Dick's Sporting Goods. Some of these retailers, man, just wow. What a great chart in Dick's. We ripped higher on earnings earlier in the month, pulled back. We got this nice tight coil, this little pennant formation here now. I think this thing's going to break higher. You got those prior 2021 highs around 147.25. Above there, got to be long Dicks. We're trading at about 144 today. Hims and Hers Health. Hims, nice base here, right? We talk about these growth stocks and the ones that you want to be buying. The ones you want to be buying are the ones that have been basing the longest and are completing these rounding bottom reversal patterns. So for Hims, that level is 9. If we're above there, this bottom is complete and the bias is higher, right? The trend is higher. We're targeting 1670 in Hims, almost a double there. Alamos Gold, AGI, right? When we talk about, we love alliteration. So bonds, Bitcoin, big tech, that's fun. And really, there's 4 B's, right? Because there's bullion, gold. Gold is doing just as well as those other 3 groups right now. And it's also very much an interest rate story for gold, right? As rates come down, and we think will continue to come down, all of those assets should perform very well, whether it's tech, Bitcoin, bonds, or gold, right? So gold, we're looking for opportunities there right now. Gold has really been ripping back above those 2011 highs. There are not many better looking names than Alamos, right? So that's AGI. We're above 1040. Got to be long Alamos Gold with a target of 15. And Coinbase, back at our target, right? So if you missed it last time I hit our target, if you got in at 60, we did talk about entering at 60 a lot over the past month or two, right? Another shot back at the upper bounds of this range. Look, I still like Coinbase. I know a lot of us own it. I still have a position, not nearly as big of a position as I had earlier in the year, but I did add some back at 60 a few weeks ago. I'm probably going to hold it here, right? And this is going to become a long-term holding for me. I want to see a decisive move above 83, and then we'll come out and we'll give you guys an upside target next week. I don't think you have to rush into it here. You know, we are overbought, or we were overbought yesterday, right? We had a really nice move just since late last week in Coinbase here, really ripping higher back towards the upper bounds. Let it do its thing. Let's see how it reacts at this level. But if this is it, and after 1 test, 2 tests, 3, 4, you know, the 5th test, we're finally resolving higher. Look, this is a beautiful base here, right? We just talked about these are what the tech stocks that we want to be buying look like, big bases, right? Look, we could draw a big base in Coinbase now here too. So this is one I'm starting to like more and more over longer time frames. I do have a position. I think if we hold this breakout above 83, that's an upside resolution. The trend is now higher, and who knows where we go. So we'll be talking about upside objectives in Coinbase over the coming weeks. That's all for today. Let's see if we got any questions here. Do not see any questions. They moving the questions to another channel on me? No. All right, so we're good. If you guys have any questions, comments, concerns, shoot us a note, info@allstarcharts.com. Otherwise, we'll see you right back here, same time, same place next week. All right, everybody, thanks for joining.